Today we have Philippe Gijsels, a man that really doesn't need an introduction. I feel like everyone probably knows BNP Paribas quite well. But Philippe, maybe do you want to just give a little bit of a background before we officially get into your presentation for anyone that might not know your history?
Well, okay, I'm Philippe Gijsels. I'm 55 years old. I'm Belgian. So Belgium is a country where they speak Dutch in the north, French in the south. I've been in banking for more than or longer than I care to remember. Always, in strategy analysis. And now, I'm responsible within BNP Paribas Fortis for the strategy and the specialist team. So I have a team of about 16 people who analyze bonds, equities, hedge funds, you name it. We've written a book, The New World Economy and 5 Trends, which is basically about the crazy world that we're living in. Came out 1 year ago, 1.5 years ago. It was in the Financial Times reading list for last summer. And if you were to ask me, would you want to rewrite things in the book? I would say not a single line, because I'm still very much convinced of all the things that are in the book, and we will elaborate on some of them in the presentation. And that's the reason probably why I'm here, that I'm a big believer that we're in the very first inning of what could be a very, very strong bull market in commodities, maybe strongest bull market in commodities that we have ever seen or seen in a very long time. And it's a very special day today and yesterday, because gold has been an uptrend for a while now. Silver was stabilizing, flatlining, and now all of a sudden, of course, silver broke out. That's meaningful. Platinum broke out. That's meaningful. So I think that over the course of the next couple of weeks, we will see quite a bit of other commodities following suit. So I think this is a very, very interesting and exciting time for mining and then for commodities. So that will be, I think, at least a big chunk of the presentation we're going to do. Thank you, first of all, for attending. I will take 15 minutes max to run you through quite a bit of the interesting things I think that are in the book. And then, of course, we can open it up, like Ali said, we can open it up for Q&A. Okay, so here we go. Our book is, in a way, an optimistic book. It's a New World Economy in 5 Trends, and I think Akali will make it available for everybody who wants to see it. It's available on all kinds of Amazon and all the other ones. They always say if you steal from one person, you could go to jail even for that. We've not stolen from one person in the book. We have stolen from maybe 100 different people, which means that we have tried to bring together all the ideas that we thought that were interesting. And this book, The Fourth Turning is Here by Neil Howe, is a book that I encourage everybody to read. And our book is an optimistic book. This is not an optimistic book. This is not something that you read when you go to the swimming pool or to the beach or the mountains. This is not something that you read under the Christmas tree. I always say Halloween is a very good moment to read this book, because it's not a very optimistic book. But if you read this book and you look at the world and you see, and you close it, it's also about 400 or 500 pages. You close it and then you look at the world and you say, that's what I'm seeing. Because we get the impression, we were talking off camera, Kelly and I, about what Trump is doing again now, and now he's making friends with China again, but he has a quarrel with Elon Musk, and they're fighting over I don't know what, and it's all very chaotic. But in a way, there is order in this. There is order in this chaos, in the sense that if you read this book, in a way, you will see that a lot of the things that are happening are predictable. I made over Christmas quite a bit of bets with a lot of friends and colleagues, and I won quite a bit of bottles by saying Donald Trump is not only going to win the presidency, but he's also going to win the House and the Senate. because that's exactly what you expect in a fourth turning. Now, what's a fourth turning? Well, a fourth turning is a period of big geopolitical uncertainty, geopolitical volatility, unfortunately, also wars. We have a war going on in Europe, Ukraine and Russia. We see the problems in the Middle East. Potentially, you will have some crisis as well in the South China Sea with China and Taiwan. So these are things that you see in the fourth turning. What else do you see in the fourth turning? Well, you see basically extremist parties. That's very pronounced in Europe, from the extreme left or the extreme right winning. And you see the center getting smaller and weaker, and the center not being able to make the decisions that are probably necessary. Why I won the bet in a fourth turning? Typically, sitting presidents, sitting governments, sitting parties of whatever color or shape they are, typically lose the elections. We've seen that in so many countries in Europe where I'm from. We have seen that, of course, in the United States. We've seen that in the United Kingdom, where the Conservatives, the right-wing party, was in charge, and Labour, the Socialists, won the elections. You've seen that in your own country with Mr. Trudeau lost the elections. Okay, Carney, I think, from where I'm sitting, and you can say that I'm wrong, played it very cleverly by opposing against Trump, and that probably won him quite a bit of votes. But the idea is sitting parties typically lose the elections. If you take that reasoning one step further, in my mind, I think that Donald Trump is going to lose the midterms. And if the Democrats are able to put somebody in the field that's more or less acceptable for middle America, normally the Democrats will win. But in the meantime, you will have a lot of volatility. What's the big reason or the reasoning behind the fourth turning concept? And it's not mine, it's Neil House. Well, it's always a period of 80 years. And why 80 years? Because 80 years is a human life, a long human life. So the previous fourth turning was the Second World War. The fourth turning before that was the American Civil War. And if you go back another 80 years and another 80 years and another 80 years, you're back in the United Kingdom with the War of the Roses, the Glorious Revolution, and so on. So these are, unfortunately, always times of civil war or wars between countries. And what happened after the Second World War? Well, there was a lot of devastation, a lot of people got killed, a lot of horror. And then people tend to say, we're never going to do it again. And then they start building the United Nations, and you build the NATO, and you build the climate accords, and you build the trade organization and the health organization. And then you build that world. And what typically happens in a fourth turning as well is that these institutions get destroyed. And then in the first turning, the next generation rebuilds the institutions and rebuilds the world. In Niels' house reasoning, this will be somewhere 2030, 2032 or something like that. It's never easy to time, but that would be the period that we get out of it. But in the meantime, you will have quite a bit of volatility, geopolitical volatility, which is nasty, but for commodities, of course, for gold, for other things, I will come back to that in a second, that's good news. Now, this geopolitical uncertainty, this geopolitical volatility will lead to quite a bit of economic volatility as well. We can no longer talk about a globalized world economic cycle, a worldwide cycle. 5 to 10 years ago, we could say, the world economy is in expansion, is in contraction, is in a recession. So there was one world economy. Today, the world is way more fragmented. It's conceivable, it's possible that for the first time in a very long time, Europe, the European economy, will grow faster than the American one. China, which is also very important for the commodity space, is in a balance sheet recession. The Chinese saved a lot for their pensions because there is not a lot of social security over there. They put it all in the real estate market. The real estate market came down heavily, and basically they feel poor. They're not investing. they're not consuming, and their economy is suffering. Now, I think eventually, and probably it will not take so long, the Chinese government will stimulate the economy. That will also help the commodity space and will also help the world economy. But the bottom line is, Europe will grow at another pace than the US does, and China will also grow at another pace than the other two do. Japan is something totally different altogether. There, for the first time in many, many years, you have inflation, interest rates are going up, and central banks are hiking interest rates. So who is going the fastest is not so important. That is a moment in time. But the point is, all these blocks will do something else. And you have to look at it, I think, as tectonic plates, where they all move together in the same direction at the same speed. And today they move in a different direction at a different speed. And you can imagine what happens then. They start to collide. And when these economic blocks, these tectonic plates collide, you see volatility in currency markets, in bond markets, in interest rates, in commodities, in stock prices, you name it. So that's the world. Summary of this important first part, I think. The world is going to be very volatile. We'll have geopolitical volatility, we will have economic volatility, and this will lead to volatility in markets. Now, I'm going to skip through a number of things, but also a consequence of the fact that extremist parties on both sides win, the center gets weaker, and typically sitting presidents are voted out. It means that it's extremely hard to reduce the deficits. This is the deficit in the United States, stands at 6%. If you read this from left to right and you start in 1950, you see that deficits are increasing everywhere. Your country, in Europe, in the United States, in Japan. And that's one of the consequences of this fourth turning, that it's very hard for governments to clean up the deficits. Big discussion how much is going to be in the United States, 7%, 8%, 6%, but it does not really matter because it's too much. And the markets start to ask themselves questions about the sustainability of this long-term debt going forward. And this here, if you do not listen, have not listened to anything I said so far, and you do not listen to anything that I'm still going to say, this is the elephant in the room. This is the total American debt. It says 35, but actually it's already 36. 36,000 billion of debt. They pay 1,400 billion in interest over that, which is more than the defense spending. Add to that the 6%, 7%, or 8%, who will say, of deficit, but you see that this debt is not really sustainable. This chart alone means two things. This means that longer term interest rates will be higher than we've ever seen. And it will also mean that inflation will start to run way faster than we are used to, because the only way to keep this under control is by letting inflation run. And that's exactly what governments are going to do. And you already know where I'm going with this. If interest rates on the long end go up and things become more volatile, but especially when inflation goes up, this is a very strong environment, a very potent environment for commodities in general. Now, this is maybe the most important chart of the slide deck, besides the commodities, which are, of course, the topic of today more. But this is the American interest rate, the 10-year from 1817 onwards. And what do you see? Well, you see big waves, interest rate waves. And these are floating on the big inflationary waves because the inflation and the interest rates are very closely linked together. And you see a decline starting in 1870. You see a decline of 31 years, an increase of 20 years, a decline of 26, an increase of 35, and a decline of 40 years. And at the end, you see COVID. And then the question becomes, is this an aberration, this COVID story? And do we remain in the environment where basically interest rates come down and inflation is behaved and so on? Or is this the first step in an environment where interest rates go structurally higher? And to answer that question, we have to ask ourselves, if you look at the world today, does it look more than the 80s until COVID, or does it look more like the 70s? And in my mind, and I cannot elaborate in very much detail on this, and we can touch upon it when we do Q&A, but our book, large part of our book, deals with the fact to demonstrate somewhere that the world that we have today looks way more like the 70s than like the period from 82 until recently. And that's a very big call to make, because when you believe that, you live in a world that's less globalized, you live in a world of big defense spending, you live in a world of big governments that interfere with everything, you have a lot of money that you have to spend on climate change, there is conflict, so there are a lot of things, and that's what we talk about in our book, that make me believe, and I'm absolutely convinced of that, that the environment that we have is way more the 70s. Well, if you believe that, well, this has massive consequences. This means when you want to buy a house and interest rates were to come down because the economy goes down a little bit or it goes into a recession, and you were to be able to finance your loan 50 or 75 basis points below where we are today, it is a very good deal. Take it with two hands, because in our lifetimes, interest rates will no longer go to 0 or 1. So if you can lock in interest rates, you should do it. When you're a company, you've lived in Valhalla. You've lived in a very good environment, because from 82 onwards, interest rates came down all the time, inflation was well behaved, and commodity prices were stable and not too volatile. So that's a good environment. Today, you live in an environment where inflation will be higher, interest rates will be higher, and commodities will be way higher and way more volatile. So as a company, you have to deal with that. And then you come, what we talk about today, to the investment side of it. When you're an investor and they let inflation run 3 or 4% a year for 10 years in a row, it means that your purchasing power will drop by 50%. So when you remain in cash for the next 10 years, you're sure of one thing, that your purchasing power is down by 50% at least. So in that world, you have to buy real assets. And that means to a certain extent real estate, that means to a certain extent also equities, but that also means, and that's the topic of today, means commodities, that means gold, that means silver, and all these things. In an environment where inflation is no longer from 0 to 2, but from 2 to 4 and potentially higher, well, that's a totally different ball game that we have been used to the last 40 years. So we have to adapt, and we have to be in real assets. I'm quickly going to skip a number of things, but this is an important one, and I'm sorry, because I should have taken the Canadian dollar against the US dollar, but the chart, believe me, is exactly the same. Since the financial crisis of 2007, 2008, both the euro and the Canadian dollar have lost ground against the dollar. If this goes American dollar, if this comes down like it is, it means that the euro is declining. It means that the Canadian dollar is declining against the US dollar. This is the American exceptionalism that everybody talked about. The US had a big deficit, still has a big deficit, trade deficit as well. So typically the US dollar should go down, but because the entire world has been buying American treasuries, American equities, S&P 500, Magnificent Seven, you name it, the dollar has been up. Each and every time that Donald Trump does a tweet, well, everybody start doubting the US a bit, start doubting the US dollar a bit, start doubting the sustainability of the US debt a bit, and it means that money is more evenly distributed over the rest of the world. So this means going forward, no longer massive outperformance of US equity stocks and treasuries, means a weaker dollar. A weaker dollar means stronger commodity prices, better emerging markets, and so on and so forth. And this is key. This is maybe one of the most important charts on the planet these days. Okay, I'm going to quickly switch to commodities, and then we open it up for questions. I've already given a couple of reasons why I think the commodity markets will do very, very well over the next couple of years, and it already started. You live in a world where you have a lot of volatility. You will have more volatility. You live in a world where inflation will be higher. You live in a world where the dollar will be weaker. But then, of course, there is also the demand and supply equations of all these individual commodities. What I'm showing here is not a BNP forecast. It's a consensus, a Bloomberg consensus for demand in a lot of the battery metals from 2024-25 until 2050. Our estimates are in this, but this is a consensus estimate. And what you see here is a wall of demand coming over the next couple of years for the commodities that you will need for the energy transition, for the electrical revolution, for the batteries, for the grid, and what have you. Now, if you make a prediction on 25 years, you know it's going to be horribly wrong. The point is, and also not the bars, they could be half, they could be double, but also the composition of the bars could be vastly different because nobody knows exactly what the battery of the future is going to look like. So if it's no longer cobalt and it's more nickel, well, you will have less demand for cobalt. If lithium were to be replaced by sodium or natrium, well, you have less lithium that you need. But the one I'm the most comfortable about, and in our book, I say the copper price could easily double, is copper. Because if you bring your electricity from A to B, you still need copper. And the point is, we all know that we need about 200 new copper mines in the next couple of years just to meet that demand, and we just don't have them. And even if you were to decide to start these mines today, you all know that it takes about 10 to 12 years at least to open a new mine. So before you get the first ounce out of the ground of copper, well, you will be in deficit for many, many years. And we know from history, from experience, that if a commodity goes into deficit, well, it's not for 10 or 20 or 30% upside, doubles, triples, or quadruples. So that's what you're looking at in quite a bit of these commodity markets. So that's the basic idea why I think that a lot of these battery metals will be structurally higher with as a big favorite copper. Of course, also the precious metals, but that's because the central banks around the world are diversifying all their holdings, all the treasuries, all the dollars they hold in gold. And silver, like I said, is making today, as we speak, an historical breakout. This is the chart. I'm going to stop in 2 minutes. This is the chart where you in red have the copper consumption, and in blue you have two proxies for the Chinese economy. On the top chart you have the floor space completed, which is a proxy for the real estate market in China, which, like I said, is suffering. And the bottom chart you have industrial production, which is a proxy for the industry, of course, which is also suffering. But besides the fact that China is flatlining and China has typically, historically, a lot of demand for copper, copper consumption keeps going up. So that's the electrical revolution for you. So this also means once that the Chinese start to stimulate their economy again, you can have a serious upside in prices. I'm going to show you one final chart, and then I open it up for questions. Then we can talk gold, uranium, whatever. The rare earths. You see a lot of discussions going on about the rare earth space. I guess in Canada you have quite a bit of them. You're not mining all of them. The US, by the way, also has quite a bit of them. Are not mining them until 1973, 75 or so. The US was a serious player in the in the rare earths, but basically they stopped mining them and they gave the monopoly to China. And this is from a European standpoint. Now we have a big problem because in Europe we're extremely dependent on Chinese rare earth exports. You see that for some of them we import about 100%, 97%, 71%. And we already had the example of gallium and germanium. At a certain moment in time, the Chinese closed down the tap and these prices went 3 to 4-fold. So this means that junior miners or players that are active in these rare earths probably also will have a very nice day. So if I said 15 minutes, I've already done 25, Kali, but I think this gives a good summary and is a good start. So this is the volatile world that we have. The reasons why I think this is a very good environment for commodities and miners going forward for the next quite a bit of years. But yeah, if somebody wants to zoom in on something specifically, please do. Thank you.
That was fantastic. I actually probably felt like I could have listened longer, but we got questions coming in, which is great. So one of the first questions for you is, with all the buzz about auditing America's gold in Fort Knox, do you think it will happen? And do you think there will be any negative surprises? And if so, uh, what will that do to the price of gold?
Well, this is already a very difficult question because I have no key to Fort Knox, so there is no possible way that I can see whether the gold is there or not. But I would say, and that's maybe moving around the question a little bit because I do not really know the answer. The fact that we're discussing this is already an indication that people are once again interested in gold. And one very important thing as well, the gold market and even the silver market, even more, is a lot of paper money. So you have these people like Sprott and probably quite a bit of others that have, when they give out an ETF, they make sure that there is physical stuff underneath that, because you can trade all the futures that you want in paper gold or in paper silver, but that's not the same. So the fact that people start to ask themselves the question, is the gold really there? Is in my mind, whether it's there or not, making extraction of that, is already an indication that there is interest. The fact that gold is moving around the world, and of course there is some arbitrage and people are buying it paper in London or physically in London and then move it to the US. So gold is moving around the globe. It has not moved for many years. So the fact that we are asking ourselves these questions and the fact that gold is moving is an indication of interest. And what's very interesting for the gold market, and I'm telling you something that you probably know, but I'm going to do it anyway. Up until, let's say, January of this year, the rise in gold has been solely a central bank thing. Central banks want to diversify their holdings of American treasuries, of dollars. They wanted something else, and they start to buy gold. So investors has been net sellers of gold until the end of last year. But even with the investors being net sellers, gold was still up because central banks were buying. So if you ask me, is there a bubble in gold? Well, there cannot be a bubble in gold because investors have not bought it. If you look at the average portfolio worldwide, and I take gold, I take silver, I take platinum, I take all the mines, well, the average holding in a portfolio of all that is barely 1%. In the 60s, it used to be 50 or 60%. So we're not going back there. But if you were already to go to 3% or 5% in each and every portfolio, you will have a massive demand for these metals. And since the beginning of the year, investors are also starting to move again in the space. And then you see also the silver price going up and you see the miners going up because central banks only bought gold, investors buy everything, and therefore it goes up. So I think, to answer the question without knowing how much gold is there in Fort Knox, basically I think what your question shows, and all the money around the world, the gold and all the precious metals moving around the world shows, is that there is an interest in the space again. But it's very early. It's only since the beginning of this year. So this is the very, very first inning of what could be a very big bull market. In our book, The New World Economy in 5 Trends, we had a target of 4,000 on gold. I wrote it about a year and a half ago. And everybody was laughing because we were at 1,600 by then or 1,500. Everybody said, you're crazy. Well, today we're 3,300, 3,400 almost. Now I see a lot of big banks, the JP Morgans and the Goldman Sachs and so on of this world, talking about 4,000, 5,000. So all of a sudden, 4,000 is not so crazy anymore. 4,000 is now all of a sudden the bottom of the prediction, but I think I put 4,000 because I don't want to shock people back a year or so ago. But I think 4,000 is not the end of it. I would not be surprised to see 6 or 8 or 10. And I would not be surprised to see 100 in silver over the next couple of years. That's what happens when these things start to move. So yeah, a lot of interest, a lot of excitement. I hope this more or less answers your question. But I honestly have no key to Fort Knox, so I don't know.
Um, with your talk about the 80-year cycle of war, can you break down of the institutions and then rebuild? Do you think it will be right or left-sided for the rebuild?
Well, that is an open question, and that's up for grabs because you never know whether it will be left-sided or right-sided. Typically, after, and that's the positive news in our book, because after a fourth turning, which is violent, which is volatile, a first turning happens. The mechanism that creates the transition from the fourth to the first uh, inning or fourth turning, first turning is that things get so bad that people say we no longer can do this. What you typically see, whether it's left or right wing, is that you get more a sense of community, a sense I'm Gen X. My kids always say that I'm a baby boomer. I'm not a baby boomer. For them, all people are old, are baby boomers. I'm the generation after the baby boomers. But the Gen X is a generation that basically is very self-centered. We read books like Atomic Habits. We're obsessed with self-improvement. We're always saying, how is our future me in 20 years going to look back at me today? That kind of stuff. Well, I think the next generation is going to, so already with my kids who are 21 and 19, they already have more like this sense of community. So whether it will be left or right, it can be both things. There's no rule about who is going to win, but the power is up for grabs, and there will be more a sense of community, and it will be less individualistic. That's typical for a first turning, but whether it's left or right, it can go both ways.
Okay. The next question. At the start of the first turning, will China BRICS have taken over from the Americas West, do you think, and as the most dominant economic political grouping?
Yeah, that's an extremely good question, and your audience is asking the right questions, but the difficult ones. Fourth turning is typically a moment of conflict, wars, and they can be civil wars inside a country, they can be wars between countries. The last six turnings that we had, it could go both ways. The American Civil War was one that was a war within the United States. The Second World War was a war between countries. There was also some civil war in Spain and other places. They can coincide, but typically you have conflict. So you don't know whether it's going to be internally or externally. And both are linked as well, because one of the big drivers why countries typically make war is that they have domestically problems and domestically tensions. And if you can find a common enemy from the outside, typically your pressure inside diminishes because it becomes more cohesive, let's say, within the countries. And that's interesting. And China, that's why maybe China would opt to move against Taiwan, is when she gets internal pressures in China, that he says, okay, if we start Taiwan, well, I will have it easier at home. So that's these two are related in a way. Now, what's also one of the important components of this geopolitical uncertainty and volatility is the fact that you no longer have a unipolar world. After the Second World War, the United States was a dominant power in the world. They were policing the high seas. They were making sure that everybody could trade as long as you were not a communist. So basically, you had a one-polar world, especially after the Soviet Union fell and the Berlin Wall fell and so on. Today, you have a second world power coming on stream, and that's China. This means that you no longer have a unipolar world, you have a bipolar world, or potentially even a multipolar world. And if you look at history once again, empires like the Roman Empire or the British Empire or the US Empire now, they tend to last for 100 years, 200 years, but eventually a challenger comes about. And if a challenger comes, it typically does not happen in history that you say, you know what, we have had 100 or 200 years of power. Let's organize a very nice party. We have some cake, and you can have the next 200 years. That's not the way it works typically. Typically, this goes with tensions. And what I think, and that is what we call in our book, not deglobalization, but we call it multi-globalization. So it means that you will still have some sort of globalization, but not over the entire world, but in blocks. And these blocks will collide. And that was what I was talking about at the beginning. So I think eventually this whole trade war thing of Trump, and he is upsetting Canada, and he's upsetting Europe, and he is making no friends in a lot of places in the world. But at the end of the day, this is about China and the US. This is about the sitting world power somewhere colliding with the upcoming world power. How this will be resolved, it will be a good question. This is in a way, once again, sort of a Cold War. Let's hope it does not become a warm war where they really actually start fighting. What will come after that, there will be certainly, in the first turning, there will certainly be some sort of peace. Whether it will be once again one world community, or you will have a world that remains more or less in blocks, but without fighting with each other, that's hard to predict. But what's happening, and that's so positive for the gold price, is that if you see the Chinese holdings of American treasuries, they're reducing them quite rapidly, and they want another thing, they're buying gold. Because if you, and now I'm going into more in the hypothetical world, but that's fine. It's Friday, already Friday evening here. It's Friday afternoon on your side of the world. But the point is, if you go to a new world order, and at a certain moment in time, the BRIC countries or China or whoever, they want to make their own currency. Well, they will need something to back it, to make it credible. And that something will be gold. And that will not necessarily, or gold and silver, or a combination of commodities or whatever. But they will need something to back it. And if you go to some sort of reset in this world environment, well, people will start to buy gold. The Chinese are buying gold like hell, and they will continue to do so. So in the first turning, you will have peace again, but you can have potentially more than one world power, and you can have potentially more than one center. So I think that the outcome, if you look at all world history, you have had periods like, this may be less known on your side of the world, but in Europe we had the Roman Empire and the Romans. You had what they call a Pax Romana, a Roman peace that lasted for about 200 years. Rome was so strong that nobody could challenge it, and then it fell. But then you had 500 years, 1,000 years, what we call the Middle Ages. Now, there was no dominant power. They were fighting all the time. And now recently you had the British Empire, which held for a while, which was fairly stable. Then you had, since the Second World War, I will not call it an empire, but the unipolar world around the United States. And now it's volatile again. But if you look at the times of the last 2,000, 3,000, 5,000 years, how many times you have one center and how many times you have more centers, you have way longer more centers than one. So I would say that you still have blocks after this is over.
This is another great question. Will the West be able to catch up with China in terms of providing the dominant global processing facilities for metals and minerals?
Well, I hope so. I hope so. But that's more a hope than it's a prediction. But we will have to act together. And you can say a lot about Donald Trump, and he does very crazy things sometimes, and he does very things that we don't particularly like in Europe either. But he wants the Panama Canal. Okay, that's not going to happen probably, but that's in his mind the way how I can transport things. That's important in our world, transporting things. He wants he made a deal with Ukraine for the raw materials. He wants to have Greenland, which is almost a periodic table of all the elements are there. Of course, he's probably not going to get it. But in a way, he knows that to be a military power, you need access to these materials. If you want to have solar panels, if you want batteries, if you want a smart grid, well, you will need to have copper and all these things, and also these rare earths. And US has them. Canada has them. In Europe, we do not have the luxury. We have a little of it, some in Spain, some in Sweden, but not a lot of it. And of what we have, we cannot mine it. So I think, but that's more a hope, and it would be extremely positive for the mining sector, of course, that they start to get their act together. And everywhere, and that's maybe good news, you have everywhere critical mineral acts. They realize that these things are critical for the armies, they're critical for a lot of the new technologies. So I think they will be more lenient on mining operations, being able to give permissions and so on. I think in some of the provinces in Canada, it's still very good jurisdiction to mine, others a little bit less. Mexico becomes more of a question mark from time to time. There you have less rare earths. Of course, you have copper and you have silver and so on, and then in Chile and in the south. So I think that this mineral independence becomes very important. And I think US and Canada understands that way better than Europe does. Because we have nothing or not a lot ourselves, and our supply chains are not very safe in that way. And if you see, for example, what's happening in the automobile sector the last couple of days, all of a sudden everybody is complaining or worried about these magnets that you need. Well, that's typically the rare earths. But it's not only automobile, it is basically everywhere. So yes, it's more a hope, but I think we will get our act together. Not we, not Europe, but you probably to a certain extent. And that will be extremely favorable for mining, because what it will do is make the permitting easier, and that will help. That will surely help.
Another question, why do you think the junior mining stocks have been lagging compared to the precious metals? And then what is your favorite two metals at this time?
Well, okay, that's favorite two I'm going to keep, because I have three, in fact, but I will narrow it down to two. But I already touched upon it. The point was at the beginning that the rise in gold was a central bank thing. It was not an investor's thing. Investors have been net sellers of gold and gold-related stocks and silver and what have you for the last many years. And it has been central banks have been buying, but the central banks have been solely buying gold. They've not bought mines, they've not bought silver, they just bought gold. So gold went up, and all the rest was left in the dumps. And also, it's in investment flows the last couple of years, or many years basically, since the financial crisis, everybody has been in American tech stocks and so on. So there was no interest whatsoever to buy mining stocks or value stocks or everything that was not Nvidia and Apple and Google was not interesting to a lot of people. And then you know better than I do, in the mining sector, especially in the junior miners, if the big miners, the majors, are not making a lot of money, they're not rewarded for doing takeovers, prices are not too high, well, they do not do takeovers. So you had not a lot of interest from investors, you had not a lot of interest from the majors, and on top of that, what's something which is very typical for the Canadian venture exchange and so on, is that you had a lot of short sellers that pushed these prices even lower. But all these things are changing, because first of all, investors are getting back. So the reason why mining stocks have been doing extremely well the last couple of weeks and months is because investors are back. They're buying gold, they're buying silver, they're buying platinum, and they're buying miners. So therefore it goes up. And secondly, the short sellers, I think at a certain moment they will have a hard time, because I think you will start to see short squeezes. And what I already see in silver, I think, is already a little bit of a short squeeze, because there are a lot of paper contracts that are short, and they were able to keep the price below the $35. Well, now you move to 36. As it goes higher, the losses of these shorters increase, and eventually they will have to be forced to close that position. And then it can get interesting. So a lot of very exciting things are happening. So this is the best timing in the last 10 years to talk about commodities. So it's fantastic that we do this today. But a lot of things are really moving in the right direction. So but that's the explanation. Central banks just bought gold. They did not buy all the rest. And now you have investors coming in and they buy all these other things as well. If you're forced to pick two, I would certainly take silver, because that's my favorite. And then it's between gold, copper, and platinum. Yeah, then I would take maybe copper as a second one. But it's
Um,
hard because I'm bullish on all of them.
we have a question about uranium too, if that's in one of your top couple picks as well.
Well, uranium is also a very interesting story, and it's in a way similar to a lot of the rare earths. It's a totally different commodity, but it's also a place where there has been massive underinvestment, like in so many places for many, many years. And of course, you had the Fukushima story in Japan. A lot of the reactors in Japan closed down. And yeah, everybody was very busy with solar and wind and everything. So they did not want to go into uranium or nuclear power. The US has a lot of uranium in its own soil. Canada has it as well. But once again, we're not mining a lot of it. US today is not mining enough to keep one reactor going. A lot of it comes from Kazakhstan, for example, where they have quite a bit of it. But yeah, it's not the most stable environment that you can imagine. And it's also very much under the influence of Russia as well. So I think also Canada and the US have a keen interest in developing these resources, and they will in a way. Now, I don't know the age of the people who are listening into this, but we have seen in the past bull markets in uranium. I think I looked it up somewhere. The last bull market, the last big bull market, the equity that did the least well went up 13-fold, and the one that did the best went up 40-fold, I believe. So that's what happened in the last bull market in uranium. And I think the stars are aligning here also. You have a lot of demand, a lot of new plants are being built. There will be a lot of demand. All these data centers and everything, they will eat up a lot of energy. So they will need a lot of new electricity. And part of it, not solely, but part of it will come from nuclear. And there is underinvestment. And if permitting is already a problem for all mining companies, it's a total nightmare for mining uranium. So there you have the lag times to be able to build new mines will even take longer. But I think they will speed it up. And I think in the US and in Canada, you have a number of very interesting players. So I think that a lot of the stars are aligning. If you look at the uranium price, you have to look at two things. You have to look at the spot price, but of course you have to look at the future price as well. In the last run-up, probably things got a little bit ahead of themselves, but at a certain moment in time, the spot price was $40, $50 higher than the long-term contracts because a lot of the hedge funds piled in the spot. That has been worked off now. So the long end, the long contracts, the prices have gone up a bit. The spot has come down. But I have the feeling that this market is preparing for a new leg upwards. And if I look at demand and supply for the next couple of years, a lot of demand, supply that will not be able to keep up. I see a lot of nice things for uranium. Of course, back in the last bull markets, don't get overexcited, you didn't have Kazakhstan. So there you had no other supply. So yeah, then it went up 30-fold, 13-fold, 40-fold, and so on. But if these things can double or triple, it's also nice. I'm not expecting that's going to go tenfold. Uh, but I think, yeah, just like a lot of commodities, I think we're here at a very early stage of a very big bull market. We've already had a nice run in uranium. It was probably a little bit overdone in the short run. Now you had this rest period of a number of months, but I think it's ready to move again.
We have another question. Was silver breaking? I think we talked a little bit about this before we went live, but was silver breaking through the 13-year high? Do you have a number where you think it's going to close at the end of this year?
Well, end of this year is difficult, but I think since you've taken out this thing, and for the people who look at technical analysis, and I don't have have a chart of silver. Yeah, I have it here. I have two interesting ones. You still see in my presentation, huh?
Yep.
You see here, since the 70s in yellow, you see the gold price, and in blue, you see the silver price. So you see basically when gold goes up, silver lags, but typically has an acceleration. And the first big peak that you see here is in 1980, January, and that's the Hun brothers. A lot of your audience is probably too young to remember these guys, but these are two brothers that cornered the silver market, and it went ballistic because $50 back then was a huge price. It fell back afterwards, but that was the Hun brothers, and then you had another peak in 2011, I believe, also of 50. So now you have broken this level. I think now the floor is free until 50, but whether it will happen until before the end of the year or not, I don't know. But I think now the breakout has opened up the area between 36 and 50. Once it reaches 50, I think you will pause a little bit, but I think eventually it will break that. And if you break that, the sky is the limit. So whether it will happen before the end of the year, but my target would be 50. With this breakout, you have room until these two previous stops. And you also see on this chart that silver is lagging gold still very badly. And you see in the previous two tops that gold moves first, but if silver starts to move, it even goes beyond it. So, yeah, I cannot be more exciting about a commodity than this one.
We have a question that feels scary for us. What will happen to Canada as the cycle unfolds with the fact that we have no gold reserves and continuous debt building?
Yeah. The bad news is this is nasty. The good news is you're not alone. I showed you the total debt in the United States. I could show you the debt level of Belgium, or Italy, or France, Japan. That's really scary. That's 250% debt to GDP. It's never a problem until it becomes a problem. And Japan interest rates were almost zero, so they did not pay too much interest on the debt. Now interest rates are going up, so all of a sudden they have to pay for the debt, so it becomes an issue. Yeah, so that's okay. You can cry about it and be unhappy about it. We can say, okay, what's the only way this is going to be between brackets resolved or at least kept under control? Well, you let inflation run. You devalue the real value of your debt. That's the only way. If tomorrow prices are fourfold, the weight of your debt is only 1/4 anymore. So that's what they're going to do. They're going to inflate the debt away. That's why I believe that you live in a world of higher inflation and higher interest rates. And what's the solution? You buy real assets. And what are real assets? Real estate, equities, gold, silver, and you imagine. So we all know this is bad, but having a lot of cash sitting on a balance on your account for the next 10 years, you're sure that you're going to lose your purchasing power. So I think you have to invest, and you also have to take on some additional debt, and you should not exaggerate because you should be able to service it. But central banks can do a lot of things, but they cannot inflate their debt away without inflating our debt away. So if you have some debt the next 30 years, and take a thought experiment. Let's take something very extreme. Take, for example, that all of a sudden prices go tenfold. You add a zero to everything. Your wages go tenfold. The grocery you buy goes tenfold. But the money that is in your account is worthless. The loan that you took out is also gone because all of a sudden it's only worth 1/10 of what it was. So that's the way you position. You make sure you have some debt, but above all, you have real assets. But the next, and I think this is a very good question, the next crisis will be, I think, a debt crisis, and not a debt crisis like we had in 2007, 2008, which was with all these crazy contracts and these CDOs and CDSs and so on. And then the central banks bailed out the banks and the individuals. Now it will be a crisis, and the timing is impossible because this can be another 5 years or 10 years. But we all feel and we all see, and then we all realize somewhere that the debt trajectory that a lot of countries like Canada, but also many others around the world, is just not sustainable. And if you ask me to take my crystal ball and to say where it's going to blow first, I think it's going to blow first in Japan, because there you have this massive debt and interest rates going up. And then everybody will say, hey, Japan has a lot of debt, but there are many other countries around the world that have the same problem. And then central banks will go loose, they will quantitative ease, they will do whatever they have, and the consequence will be massive inflation, and then you're very well positioned in real assets.
We have another question that kind of fits in as a secondary question to this. Are you optimistic in the long term, say 50 years on Europe and the USA, declining birth rates, and obviously, as we just talked about, debt levels are concerning?
Yeah, that's indeed another issue, and that's also one of the chapters in our book, demographics. It's not a very happy story either. We have figures in the book, and I know some of them more or less by heart, but it's all very nice in a table. And of course, you make assumptions because you have to make assumptions on the birth rate. You have to make assumptions on the immigration. But all in all, demographics are in economics still one of the best things to be able to predict in a way. And well, if you look at the figures, I don't know by heart by Canada how it's going to be. But the United States, the population is aging, but is also staying more or less at the same level. Europe, Belgium is still going to be more or less okay. We will have the same population, but countries like in Germany, like in Italy, like in Spain, like in France, they will lose about half the population. Japan, in 2100, they will almost have died out because there are almost no children and there's no immigration. China is now comfortably above the 1 billion people. They will be at 600-700 billion. So they will be not much more than the United States at that moment in time. Russia is a disaster. They will also almost die out. The only place in the world, India will remain stable. India will remain for a very long time the most populous nation on the planet. But the challenger will be, and you know where I'm going, Africa. Africa today has 1 billion people. In 2050, they will have 2 billion people. In 2100, they will have 4 billion people. So that's where the population growth is, which makes it a very big challenge for Europe as well. Because if they cross the Mediterranean Sea, only a small part of it, well, you have big immigration issues. And on the other hand, you probably need the young people to do the work. Big question will be how much robotics can help and so on, but demographics will be very important. And then, yeah, world population, the only growth will be in Africa, but in total, the world population will stabilize, start to decline. Chinese population is already declining at the moment. It will age, making the debt burden even more complicated. Imagine Japan has a debt to GDP of 250%. If you halve the population, well, your debt per capita, it becomes astronomical. So it looks like very long-term problems because then we're talking about 2050 and 2100, but it are clearly, in my mind, problems. So yeah, that's something to look at. And I think we do not look enough at demographics because demographics are indeed very important. Therefore, it's an entire chapter in our book as well.
Wow. I mean, I don't love hearing that, but this is fantastic information for all of us. Um, this is my personal question for you, Philip, but as far as like you're talking about assets to hold, like equities as well, are you still thinking like the Mag Sevens and some of those bigger plays, long term, short term, are still in effect for portfolios, or as this commodity super cycle plays out, that people should strategize out of some of the more
Yeah,
popular?
I think when you have a holding that is disproportional, in that you probably better shift some of it. If you look at the MSCI World, that's a world index and that's a benchmark for a lot of investors around the world. 75% is US, but that's a lot. The US is not 75% of the world economy, but it's 75% of the market cap, and about, well, 40% of that is in these Magnificent Seven. So that's probably too much. So I think we will go to a world where the dollar will weaken, where, like I said, money will be distributed more evenly over the planet, so that a lot of other teams like small caps, mining stocks, commodities, and so on will have their day in the sun. On the other hand, with all the interesting developments you see in AI, you see in quantum, you see in internet security, you see in robotics, what have you. Well, you cannot afford not to be in them altogether. And also for Europeans, okay, we have a number of very interesting tech companies, but not a lot of them. So if you want to play these revolutions, and they are really revolutions, you probably will need to be in the Magnificent Seven as well. So I think it would not be a good idea to be totally out of the US, to be totally out of technology, but probably the weight that they have in the total scheme of things is probably too high. So you will see some rebalancing. So I would be in them for a certain extent, but I see, like I said, a more evenly distribution over the rest of the world, a weakening dollar, and then potentially a lot of other teams like commodities and so on will benefit. So, but totally excluding them, I would not do, because then you miss out on, yeah, on all the technological revolution that's happening, and then I think that would be risky as well.
Well, another question, is a combination of gold and short-term T-bills the best for safe money?
Um, Gold, certainly. Gold is a safe haven. Short-term T-bills as well. There you run less of the interest rate risk, because the interest rate risk you run more at the long end of the curve. Of course, it's less of a problem for an American, but it's already a bigger problem for a Canadian, and even more so for a European. If the dollar weakens and you're in these US denominated T-bills, yeah, you run the currency risk. If you buy shorter term Canadian paper and your shopping is in Canadian dollar and your debts are in Canadian dollar and your salary is in Canadian dollar, well, it's a fairly safe place. So you have less credit risk, less interest rate risk. But there I also would avoid the currency risk. I would do it more in your own currency, I think. I showed you the chart of euro against US dollar, but the Canadian that has been depreciating for many, many years against the American dollar is probably also on a turning point. So I would stay, if I were in cash, and I would not have too much cash, like I said, because inflation will eat up part of it. But indeed, having some of it there, I would rather have it in Canadian dollar than in American dollar.
Another question from me personally. We're about halfway through the year now, so I know you're talking about the fourth turning and a lot of things that are coming into play. As an investor or someone in the market, what is like another key trigger, I guess, that you should really pay attention to as far as building up on that commodity side that we might see, you think, in the next 6 months?
Well, I think commodities have started their upward move for many years to come. So there will be pullbacks from time to time. I would use every pullback to load up on these things. The biggest question is that like I said, the book that we've written, I would not change a thing at the moment. Things are playing out like we thought it would. The biggest surprise maybe this year is this American exceptionalism thing that's been put into question, and that you, after years and years and years of outperformance of U.S. assets, bonds, equities, and the dollar, you now see, like I said, this more evenly distribution around the world, and we should keep a close eye on it whether this continues. But I believe it will. I would not be surprised to see the dollar. I don't know I know it against the euro. It's not meaningful for you. It would be 120, 125. I don't know by heart what exchange rate Canadian US is, but I would look at that. Some surprises that can happen is an additional conflict, Taiwan or something else. A positive surprise could be, for example, that all of a sudden you have some sort of a ceasefire in Ukraine. That's also possible. And that would probably create some profit taking in the metal space, and in the precious metal space. That would probably see some profit taking in defense stocks and so on. But that would probably also be an opportunity to load up. So that's the way it goes. But I think that the trends are fairly clear at the moment. We should be watchful that these trends remain in place. But I have not talked about palladium a lot, but palladium was in the doldrums for a very long time. It also broke out. So you should gradually see, I think, after the precious metals and then the semi-precious metals that are also industrial, like palladium and like platinum, sorry, and silver, that you probably will see other commodities added to this bull trend. So I would not be surprised to see other ones. I'm still waiting for lithium. Lithium is still very much in oversupply at the moment, but the World Bank predicts that the demand for lithium will go up tenfold between now and 2050. So at a certain moment in time, I don't know whether it's this year, you will go from a surplus to a deficit. That will also be a very interesting entry point. But my hypothesis would be that over the next months, gradually, you would see other materials adding, also hanging their wagon to the bull market train. And each and every time one is added, it gives more credibility to this big cycle that's moving. So you should have extra commodities added to the bull market, and you should not see commodities falling from an uptrend to a downtrend. And up until now, I do not see it, but we also have to be very watchful for that kind of thing.